Greetings to my Wyckoff friends. Welcome to Power Charting. I am your host, Bruce Fraser. Let's talk about this rally that we seem to be in at this time. Will this rally continue? Are the internals overbought? We'll look at some of the internals that gave us green shoots that indicated a rally potential, where they are now. Is seasonality favorable? Seasonality has been most interesting. Let's have a look at that. Review of interest rates and the dollar. So interesting at this time. And then finally, sentiment. We're going to look at some new indicators to us here on Power Charting. Sentiment, is it bullish or bearish? And I contend it's very interesting. So to get started, let's look at seasonality. So the month of October here in this seasonality study is the best month of the year. In fact, October was up just a skosh under 8%. The midterm election year only seasonality chart that we have put together here, we've been looking at it really since the third quarter. And we went back 72 years. We used midterm election years only, this being a midterm election year. And we saw that right at the end of September, at the end of the third quarter, we had a spring low. And this spring low produced a reversal and a rally, the best rally of the year of 2022, arguably, potentially with the seasonality indicator. And so we started off with a bang with the October advance now in November. And like I said, up almost 8%. So where are we now? Well, we did this overlay prior, and here it is. It's scary how close it has really mirrored the seasonality chart. And I'll let you study this. You can stop the video and look, but there's a low in June, a low in June in the seasonality, an actual low in 2022. There is a spring low and a test in the end of September at the end of the quarter. This has produced the start of a rally. We're looking at the S&P 500, and we can see that there's been a rally here and then a pullback. We've had a rally here and a pullback, another rally to a higher high, which has in fact occurred. With a pullback, the market seems to be pulling back at this time. And then two more advances with marginal pauses along the way into the end of the year. So again, the market is not disappointing relative to the seasonality indicator. And let's keep an eye on this as we go. Now, we had some advance warnings about this, and that was the green shoots. Let's take a look. As a matter of fact, I will, if I can get my little magnifying glass, I'll blow this up. And here, this is the New York Stock Exchange. Stocks above their 50-day moving average. This is through the end of October, October 26th. And note that we had, well, historically, January, February, we had green shoots, resulted in a rally. We had green shoots in May, resulted in a rally attempt. And then we had the important August, July, August rally, which more showed up in the NASDAQ green shoots indicator. Well, let's go over here and have a look at this. So this is so interesting because the NASDAQ has been relatively weak. The index has green shoots May, June, with lower lows in the index, but the green shoots signaled the potential for an important rally. We like to say we want to see non-confirmation of the lows and then upward direction. We saw this again in September, October, green shoots, lower lows in the indicator, and then it started to take off. Well, this is just through the end of October. Now, this is something that's very interesting. This is the NASDAQ. Again, stocks above their 50-day or 200-day in this case, June low, then a late September low into the end of the quarter. Well, guess what? If we compare this to the index makes a lower low, as described by this purple line. Higher low in the stocks above their 200-day. This is a long, slow indicator of potential green shoots. And here we are making a higher low. Is the internals improving in the stocks above their 200-day from a very low level? Again, this is below 10% here and below about 15% here. Very low number. Markets washed out. Very few stocks are in uptrends as defined by their 200-day. And now we have upward directionality with a divergence that goes all the way back to June. So now, what I contend is that these mega cap stocks that dominate the NASDAQ index are keeping the index down because they're underperforming pretty dramatically at this point. But there are a number of smaller NASDAQ companies that have a combination of good growth characteristics, better value, that are going up and going up better than the market. This is called rotation. We have talked about rotation in the last number of weeks. So where are the green shoots now? This is again going back to stocks above their 50-day. The 50-day is much more sensitive, but again, you can see the positive divergence along here and an upward stride of the green shoots indicator, more and more stocks. So the stocks now are around 50% of stocks are above their 50-day. So I ask the question, is this a characteristic of a market that is now becoming somewhat overbought? So let's move on and let's look at this indicator. This is the stocks above the New York again, 200-day moving average. And this indicator at this time through November 16th is around 44%. So is the market overbought because it's gotten into the area of where the August peak was? Well, and notice that this rally is a little bit more mundane than the rally that we had June, July, August. And so the question becomes a little bit of, are we having a poor rally? Well, that could very well be. Let's take a look at this in a slightly different perspective. This is going back to the end of 2020. This is the bull market that started in 2020 and had rallied quite dramatically. You can see stocks above their 200-day on the New York peaked out around 85–90% back here at the beginning of 2021, even though the market kept going higher for a period of time all the way into the end of 21. This indicator was in a downward trend, meaning that stocks were falling away, underperforming the 200-day, going into primary downtrends, etc., and so on. So can we say that this market is overbought at this point? Well, if it's in at around 40% at this time, and we could get up to as high as into the 90% area, and I'm not saying it's going to do that this time, but there's a lot of room up here for the market to be able to go higher and go into a more overbought condition than it is right now. And it's still well below 50%. So there is room to move up from here and continue the uptrend that we are currently in. Now let's look at the Russell for a minute, and then we're going to look at the S&P. Note the downtrend. This is since November. So the Russell peaked out before the S&P 500 in November, where the S&P, you'll recall, peaked out right at the end of the year. In a downtrend, downward stride with an overarching overbought demand or overarching supply line, and then an oversold line here. Well, a rally up and out in August pulls back into the channel, can't go back to the low of the channel, and then is starting to rally and is again up and out of the channel area of the 2022 bear market. So note that the relative strength to the S&P 500 has been in a rising trend, higher lows, higher highs, as we've gone through from May, June to the present. This is a measure of outperformance of the Russell 2000, which is really a portfolio of smaller and mid-cap stocks with better value characteristics, and many of them have good growth characteristics, largely domestically oriented companies, and they are outperforming the very large indexes, which are dominated by these mega caps. Note the bottom cell on this chart, and this is relative strength to the leadership of the NDX. Many of these growth stocks are in, I'd say all of them are in the NDX. And note the really positive relative strength performance of the Russell 2000 ETF to the NDX. So that is a clue about rotation. So now moving on, let's have a look. I showed you this chart last week, so I will very briefly go through because we are going to run out of time. This is the June, July swing trading accumulation structure. Beautiful count, missed the top objective by one box going to 200. Here is the current structure that we're in, and this structure could potentially grow larger, but this one reaches up to 194.206. And does that mean that this is the end of the move in the Russell? Well, I believe that it's possible that the Russell may be building a much bigger accumulation, and then we're going to have a bigger point and figure count for higher objectives. We'll watch and see. The thing that we'll notice is that any kind of a pullback, whether it comes here or from here, should be shallow, brief, low volume, etc. Okay, here is the S&P 500. You have seen this chart before. This is two swing trading counts, similar to the one I just showed you with the Russell. Counts up to this 4175, 4025 level. The red arrow, because this is a chart that goes back to October 24th, this red arrow is where we have rallied to. We have fulfilled the minimum count objective of this yellow shaded accumulation swing trading area. So do we still have the oomph to get up to this 4175 level? And I've made the case in the past that we could be building a larger count objective for a bigger move. Well, let's update the look of these charts. And now, there's a lot on this chart. This is my working chart for the S&P 500, which I've cleaned up. Well, I cleaned it up. I kept it clean since the beginning of the year. This has been the one that you and I have been working on together. And I leave all the notes on here because I want us to be able to see what our thinking was in real time as we've gone through this downtrend of this bear market. This is through November 16th. Screen capture it and study it, because all of these support and resistance lines and notes and everything else is all designed to give us an idea of what we were thinking at the time. So we can see the end of the quarter, important low with a climactic acceleration, down below the trend channel, a test that came in early October, an important rally. Note that we are not yet above this resistance line or this downtrend line or the 200-day. All of these represents resistance of sorts for this chart and for the S&P 500. And we're not there yet, grinding through overhead supply as we go. And so here is the difference between the S&P and the Russell 2000. The Russell 2000 is already up and out of this channel. And that gives us evidence of the rotational effects that are taking place into other areas of the stock market away from these mega cap names. That does not mean there aren't some stellar names in the S&P, because there are. We will address those as we go into future weeks in power charting. And here we have a note about green shoots emerge. We just looked at those. Let's take a look at the point and figure chart. Here is an updated swing trading point and figure, one box reversal. This count is larger than the one we just looked at. Note that it goes to 4,100, 4,350. Well, this is interesting. So we have a smaller count, which I think is a relevant count, up to 4025, a larger count now that grew wider that has gone up to 4,100, and we're still a couple of boxes away from that. Also, we have this count that goes to 4,350, which is just above this peak that we had in August, which went to 4,300. That would make a lot of sense to go up to this 4,300, 4,350 area and then turn back down into what we would call a last point of support, where we have a pullback of sorts that would then give us the potential for a much bigger count. Now, that's a bullish interpretation. We may not get that. We may have a bear that is going to reassert itself, and we have to be very, very careful with our risk management as we go forward. So just keep that in mind. And so now we're going to watch very closely the risk and the supply overhead at around this 4,100 area, and whether it can get up to the 4,300, 4,350 area before pulling back again. And then, and we'll just, every step of the way, we'll watch the unfolding picture. But so far, the rally's been quite good in many areas and has treated us well. So we just keep moving up our stops and being really careful. Let's take a very brief stop with the dollar because it's so darn interesting. This is a chart, as you know, that we've been looking at since it formed this trend line that goes back to 2018 first quarter. Here are the two anchor points of the lows. This is a demand line, picks up this stopping action here in 2021, which we had called for a rally. Wow, what a rally we got. We have an overbought line off of the midpoint of these two anchors. This gave us a stopping place in 2020, which was quite dramatic. We've studied this in great detail in the past. Now we have an acceleration up into a buying climax. And you can see it here, buying climax, automatic reaction. This is on the weekly chart. Well, what has happened since? Let's take a look. And here is the buying climax on a daily chart. This is a local trend channel, not as big as the one we just looked at. Overbought, throws over, look at the gaps, acceleration, that's exhaustion. And it comes at the top of the channel and then reverses hard in an automatic reaction almost instantly. Back in, we said at the time, this is at best case a range-bound market for the dollar. Now it's tested twice, come back down to the support of the automatic reaction. At this point, it's still in the channel as of October 26th. What has happened since? I want to show you this because it's just dramatic. It's so interesting. Another test in the channel, and then a very sharp decline out of this uptrending stride with gaps. And I believe that the dollar has something akin to a reverse V-top and is now sharply declining and could continue to do so because of the dramatic nature of the decline out of here. Wouldn't surprise me if it didn't rally up into the overarching demand line before continuing on down. That would be very typical. Okay, moving on. Here is the yield curve, 2s, 10s yield curve. So we're looking at the yield. Here's the yield of the 10-year. Here's the yield of the 2-year. You've seen this before. This isn't even a particularly new chart. It's like October 18th or something. But I just want to point out, yield curve is negative. This is a sign, the yellow shaded area of recession. So now, the other thing that goes with this is so darn interesting is to look at what has happened to the 20-year Treasury TLT ETF. And here's a downward stride. Look at the throw under with the acceleration below the oversold trend line of the channel. A test comes back in and tests. Now it's attempting to rally. This says that interest rates are tired of going down and are starting to trend probably sideways for a period of time. This is a great respite for interest rates that is probably helping the market to rally. Now let's take a look at the point and figure. You've seen this before. I've added some data here. I've updated it through November 17th. We have from the distributional top, whopping decline from 152 down to a count of 91. It goes range bound 101.91. Look at the acceleration down and out of this point and figure downtrend channel, throws under here, here, and here, goes to 92, misses the low count by 1 box, 1 point. And now it's sharply rallied back up into the channel. I think it'll just bounce around in the channel for a while, but great job point and figure analysis. This is great stuff. All right, we got to keep going. We got a lot to do. Dow Industrials is this huge channel back to 2011. You've seen this before. I want to just show you what happened because we were on the precipice of real trouble when the markets went down to these demand lines that were 10 years in the making. We went down, we became oversold, touched here, and this is where we had the green shoots. The big red bar is September. The October bar, this is not the whole October bar, but I want to show you where we were at the time. This was October 19th, and a rally began taking us back from the edge of real trouble in the markets. This may be trouble in the future. We're going to keep a really close eye on this, and you can see these touches and how beautiful this demand line has been. And so now what has happened since? Let's bring it up to date. This is through November 17th, and the rally, the October rally was quite good. We saw how well it performed in the S&P 500, up 8%, thereabouts. And now we're back into the middle of the channel at this time. Can we get to the top of the channel? Definitely we could. We don't have to. This could be a lower high test of the 2021 end of the year high. But for now, we're moving up on a big scale, monthly bars. So this is very interesting, and we will watch it closely. Now let's look at what happened with the NASDAQ 100. Went down, touched the demand line all the way back to 2010, 2011, 2 anchor points right here. And then the stride, here's a touch, here's a touch, here's a touch, here's another touch, right on the edge. Again, the 4th touch. Often these are the points where breakdowns occur. We didn't get a breakdown, and we said at the time that we were quite worried about that. We were on the brink, but there was reason to believe that we could have a rally and come back up into the channel. And part of that was because of this oversold condition that we had in the put call ratio, and the put call was pointing to extreme pessimism at that time. What has happened since? Well, interestingly, the NASDAQ 100, dominated by mega cap, which are underperforming now, has rallied a bit, not like the Dow has, not like the S&P has, but it's back up into the channel. But note this interesting thing, and this is our next topic, which is sentiment in the 2 minutes we have left. And that is, you can see that the put buying and the put activity has continued to rise on this very long-term 10-week moving average. Quite an unusual situation. It shows that pessimism is becoming more extreme as the market is attempting to rally up. Fascinating situation. Okay, so let's look at the put call ratio on a 10-day moving average basis. And here we had pointed out when this extreme had happened that we had extreme pessimism, and we would look for a turn and a trend to indicate the market was ready to rally. This was the S&P as of October 19th. What has happened since? Something quite fascinating. We're going to use, I believe this is accredited to Joe Granville, climbing the wall of worry. And note that as the S&P has been rallying up, something quite fascinating has happened. The put activity is increased. This is very rare. You rarely see this in this ratio. More pessimism as prices are rising. That's quite incredible. The last chart that I want to show you is, let's look at, in this case, this is AAII sentiment. And as a matter of fact, I'm going to go to an overtime segment and keep going. We have just a few more charts to show you, but I think they're so important and so valuable. And this really goes to the idea of, will this rally continue? The internals are not overbought. This is a summation of our prior discussion. Internals are not overbought yet. On a long-term basis, they could get higher if you look at the percent of stocks above the 200. They're in the 40s right now. They could get up to the 60s, the 70s. And if it was a big bull run, I'm not expecting that because we are on recession watch. It could get up into the 80s and 90s percent of stocks above their 200 as a definition of an uptrend. Not expecting that, but we have to be on our toes for a reversal, but especially because of the negative yield curve. Seasonality is still pointing up into the end of the year. Fourth quarter in a midterm election year is the best quarter of the year. So far, so good. It's almost acting a mirror image of the seasonality. Quite impressive. Review of interest rates and the dollar. So the dollar is weakening, and also interest rates are tired of going down, have started to stabilize and even turn up. This coincides with CPI and PPI numbers, which just were reported this week, last week, which are quite favorable and a surprise improvement over the incredible pace of inflation that we saw prior. So this could actually have the effect of causing the Fed to moderate going forward their policy of rate increases. I expect this to happen. So how much that can help the market, we'll see. The other part of it is that the Fed has been raising rates, and they did in fact raise rates to the place where something in the economy broke, and that is some of the crypto space. So we're seeing stress in the crypto area, which I think is largely the effects of the need for liquidity by the system and reaching out into these markets and grabbing liquidity, and always the more nominal players break at the point at which liquidity is being sought. We are in a tight money environment right now. We've talked about that in prior episodes. And then finally, we're talking about sentiment right now. So let's get right to that because it's so darn interesting at this point in time. So here, this is the National Association of Active Investment Managers. These are investment managers that are effectively market timers. I've spoken to this group before. They are a number of very, very good people in this group. They do a wonderful job. And this is not to imply that their level of pessimism is a negative or a positive, because in fact, they are, for the most part, exceptional trend followers. So they will start to see the emergence of a new trend, and they will participate in that trend, and they'll do it quite effectively. But they will tend to be very defensive at the bottom. So here you can see this is a 13-week moving average of 13-week data. This is just the net exposure of these investment managers at a point in time. You can see it gets up to near 100% at the peaks, or a level of 100, and down as low in the teens at the lows. And this is, you can see these valleys down here. This is a period of extreme pessimism towards the market, coincides with important lows in the market. So here's 2015-16, very low level of exposure, which starts to go up with the new trend. And like I said, they are very effective trend followers. So here you can see at the end of 2018, a very important break in the market, and they became somewhat pessimistic. Here in 2020, they were very underexposed to the market. This is all classic sentiment type indicators. By doing a 13-week moving average, we can see a smooth rolling period. Note that here in 2022, that there's a long period of general underexposure, and the 13-week average is the lowest it's been all the way back to 2015. So that shows extreme pessimism. Now let's look at the American Association of Individual Investors. They poll their people and then they publish that information. Similar concept to what we just saw with the NAAIM data, and that is that you see these very low periods of exposure or extreme pessimism that occurs with the AAII data. And here in 2020 at the COVID low, extremely low, a little hard to see. I'll blow it up for you, but I do a 13-week moving average of this data. And so here, quite low on a 13-week basis. Here in 2020, extremely low. 2022, related, I think, to the extreme posture of the Fed and rising interest rates and inflation, the 13-week data is the lowest that it's been going all the way back to 2016. Extreme pessimism. So this extreme pessimism, could it worsen? Could it go lower? I think this is about as bad as it gets, about as low as it can get on a long-term moving average basis. Now, does that result in higher prices? Well, this is typically what happens, but it could take some time to continue to build the accumulation structure for that, which also could show us better data from the Fed. Here is the AAII data going back all the way to 1988. And I've yellow shaded these very low valleys of underexposure. And this is a 1990-91, which was the Middle East event conflict. Here is 2002-3, which is the end of the great dot-com collapse. Here is the Great Recession period. Here is the COVID, and here is the current 2022 bear market. And in each case, you can see how deep the valleys have become. Now, this, and I will blow this up again. This is a level of 1. Way up here is a level of 8. So there's less than 1 bull. You could say bulls to bears, because it's just the net of the ratio up here at the top. And you can see that it's at this time is well below 1 bull for every bear. And so the bears are much greater than the bulls, as you can see up here in this data. And the valley is quite low, extreme pessimism. So the market's ability to keep going down, it could go down further, but it's now many people are really have raised a lot of cash, have been underexposed to stocks here, at least in the area of the lows. That creates the conditions and the fuel for cash money to come back into the market. And then so extreme pessimism at this time in the put call data, in the investment managers, professional managers data, and also in the individual investors data. And so all across those areas, and they're all different time frames, different styles, they're all uniformly pretty pessimistic at this time. And the put call data continues to show more put activity as we go further. Last chart, and then we'll say goodbye, is this is crude oil. We've, I think, done a super job on crude oil. Wyckoff has really been extremely helpful. This is a point and figure chart I did back when crude was in the 30s. I've shown you that point and figure chart. This was the count objective, 92-112. The yellow shaded area represents the range of that count. We had a buying climax that went above the 112 and immediately collapsed back down to the 92 area. Range bound thereafter on the upward trending channel with an overarching reverse use of trend lines or a supply line. It had an upthrusting test of the buying climax and has turned back down into the channel, immediately showed volatility back to the bottom. Note what's happening now, which is a rally attempt back into the channel that fails, another rally attempt back up into overarching resistance and the trend channel, and it's turning back down again. I think that crude oil is vulnerable here, needs to be able to rally, get back into the channel, and show the ability to move upward on good volume with ease. And it could do that. But right now, I think this is a very vulnerable place. And with that, I'll say thanks so much for watching. Happy Thanksgiving to those of you that celebrate Thanksgiving in the US and in Canada. And let me just say that gratitude is one of the most positive emotions, in my opinion. I have great appreciation, great gratitude for you, my fellow Wyckofians and viewers. I appreciate you every day. I appreciate you keeping me sharp and keeping me on my A game. I think we've had a really good year this year in a very difficult time, and I look forward to continuing on attempting to provide you with thinking and approaches to these financial markets, and for you to become a phenomenal, masterful Wyckofian. And I know many of you are already there, but we want to create as much excellence in our community as humanly possible. So thank you all, and we will see you not next week, but in 2 weeks. Take care, everybody.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.